Ever felt your profit margin vanish overnight just because the currency moved? Let's fix that together.
When you sell or buy across borders, your revenue and costs are not always in the same currency. That mismatch is the root of FX risk. Every movement in the exchange rate can shift your actual profit, sometimes in your favor, sometimes against you. Here, each spike shows market stress, often linked to policy shifts or geopolitical events. A 5% swing in euro to US dollar can easily wipe out a full quarter's profit margin if you're not protected. This volatility isn't random. It reflects global liquidity, interest rate gaps, and investor sentiment. That's why managing FX isn't speculation, it's margin defense.
Currencies can be your friend or your biggest risk. Let's uncover what volatility really means.
Let's take a real example. A German exporter budgets $1 million in sales, expecting 930,000 euros revenue at a rate of 1.075. But when payment arrives, the euro has strengthened to 1.05. Revenue becomes 952,380 US dollars times 1.05 is equal to 904,000 euro, losing 26,000 euro of margin instantly. Even though sales stayed constant, exchange rate movement quietly reduced earnings by nearly 3%. This is why CFOs call FX the silent profit killer.
So, should you hedge for safety or hold for opportunity? Let's find out.
Hedging is not gambling, it's insurance for your margin. You enter a forward contract to lock in the exchange rate today for a future date. Notice how the forward rate locks your expected conversion, removing the exposure window. If euro to US dollar moves from 1.07, 1.02, 1.08, the hedged company keeps the 1.07 rate regardless.
Let's talk about hedging, the smart way to buy certainty in uncertain markets.
The goal isn't to win or lose on currency. It's to make sure your operational decisions drive your profit, not random FX noise. Orange, earnings fluctuating with spot rate. Red, earnings stabilized by forward rate. Stability allows better cash flow forecasting, budget accuracy, and investor confidence. Tools include forward contracts, options, and swaps, each with unique cost structures and flexibility. Most exporters prefer forwards for simplicity.
Sometimes the bold choice is to hold, but only if it's calculated.
Choosing to hold means keeping exposure open, betting the market will move in your favor. This strategy can work when you have a natural hedge, meaning your income and expenses are in the same currency. When inflows and outflows offset, the risk shrinks automatically. Holding the remainder might make sense if your exposure is small or the cost of hedging is too high. But remember, holding out of hope, not analysis, turns finance into speculation. If payments are delayed beyond 90 days, the exposure window widens and your forecast reliability drops.
A good hedge isn't a one-time deal. It's a disciplined policy.
Professional CFOs don't hedge ad hoc. They follow structured policy frameworks. Key elements. 1. Hedge ratio. Define the percentage to hedge, say 70 to 80% of confirmed orders. 2. Action thresholds. Set trigger points. For example, hedge the rest if spot rate moves greater than 3% below budget rate. 3. Tenor management. Match hedge maturity to payment dates, 90 to 180 days. 4. Performance metric. Measure hedging success via EBITDA stability, not short-term FX gains. This graph shows how strategic hedging stabilizes earnings, even if total revenue fluctuates. FX management shouldn't be reactive. Companies must predict potential movements, analyze exposure, and decide how much risk they can absorb. By following this loop, you transform FX management into part of enterprise risk governance, not just treasury activity. Notice, full hedge equals stable but limited upside. Partial hedge balances protection and opportunity. No hedge offers high upside but massive downside. Most mature companies sit in the middle, partial hedge around 70%. Dynamic hedging allows continuous adjustment based on market signals like interest rate differentials or macroeconomic shifts.
Let's see what happens when two companies take opposite paths.
Company A hedged 80%. Company B held 100%. Scenario: USD weakens 5% in 3 months. Even though both face the same market, Company A preserves 4% of margin through hedging discipline. Over a fiscal year, that could mean millions in retained profit. Beyond numbers, hedging builds credibility with investors and board committees because it demonstrates financial control, not chance.
So,
Hedge or hold. The right answer lies in your risk DNA.
Hedging is not about predicting where currencies go. It's about protecting what you've already earned. If your business relies on USD revenues and euro costs, hedging should be your default. Holding is a choice only when supported by solid exposure analysis. Build policy. Monitor exposure. Measure success by margin stability, not by currency wins.
If you want to master FX strategy and margin protection, watch full playlist. Let's make volatility.